Hello, and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Jeff Hirsch, editor-in-chief of the Stock Traders Almanac. Welcome to the podcast, Jeff.
Mike, great to see you again. How are you?
I'm doing well. You know, it's funny. I know you're kind of on summer vacation here, so I really appreciate taking some time out to talk. And it's ironic because on Twitter a few days ago, you talked about how the market needed a summer vacation. That's sort of what you were expecting. So I was wondering if you could talk a little bit about that. I mean, what was behind your call there? What was it that you saw that kind of told you, this market may be needing a breather?
Well, I mean, summer is a time the market takes a breather, generally, seasonally speaking. It's been tracking the seasonal patterns very closely, including the 4-year cycle, pre-election year patterns, and it's tracking those charts so closely. It tends to continue in that direction, and then we got a bit of an overbought situation. Sentiment had gotten pretty rich. There's other news items and factors going out there. Congress goes on vacation. It tends to be a time when things quiet down. Volume ticks down, and kind of a combination of sentiment, technicals, and the seasonality, potential for some disappointments from the fundamental side of things to sort of, force that to happen. But generally, the market's following the behavioral patterns of institutions and individuals. Beginning of August was weak, very typical. So it's just tracking closely to our work.
Yeah. And, look, I mean, I'm going to give you a shout out here. You've been spot on in terms of your expectations for the market this year and for the seasonal impact. So kudos to you on that. Let's talk a little bit about the reaction of the news that we've seen lately. We kind of had ostensibly good news on inflation, but ultimately that got sold. Now we've got some issues with pump prices and gas going back up and so on. When you're on vacation, you certainly notice that driving around. I'm just kind of curious, is that going to revive fears of sort of this inflationary issues that were part of the problem for this market several months back?
I think it can. And I think that will feed into that, September weakness as well. I mean, when people come back from summer vacation, they tend to clean house, prepare for the third quarter, and we see those September corrections. We have one last year. It's setting up again. And I think that, first of all, the inflation number, if you look at the two, data points, it's really 3.3%. And they put out 3.2. I'm not sure that they sort of glazed over that. We did a little bit of a study on projections for the 12-month, the year over year change. And if we don't get below 2.2 month over month, it's going to go up.
Yeah.
So the next number may be higher. And I think that can feed into, the overall overbought situation, that we've had, as well as the seasonals and that, triple witching in September that lead into the and then Q3 pre-election year is not great. We had a big July. I don't know if you saw the hot July's autumn buys post I did out there. Tendency for the market to really find a lower level after the big July over 3% for the Dow. Works on the S&P and the NASDAQ also. Usually around September, October. Surprise, surprise. So I think the inflation number can be an issue, and but not something sinister. I'm looking for 5 to 10% thereabouts, not much, not more, honestly. And, probably new highs by year end. I don't know if you remember at the beginning of the year when we hit our January trifecta, the Santa Claus rally, first 5 days and a full month. One of my concerns, my fears was that I wasn't bullish enough.
Yeah.
And we ended up being, higher than my projections. I was at, our best case scenario was 15 to 20%. We blew through that on NASDAQ and NDX easily. But I think the inflation stuff, and who knows what other wild cards come out of China or Ukraine or the usual hotspots in the Middle East and what have you.
Yeah. Let's talk a little bit about depth and breadth of any pullback here. I mean, as we're talking, Dow's trading for around 35K, S&P about 4450, and NASDAQ around 13.7. And we've already, of course, seen the market pull back a little bit over the last week and a half. How long could this thing go on for? How deep do you think that any correction or pullback could get?
I don't think it's going to be very deep. I think there's a lot of bullish underlying factors economically and corporate wise. I think we're doing the very, very typical pause, summer doldrums, quiet period. As I said, I don't think anything more than 5 or 10%, and probably under 10. And I don't think it goes much past October. And fourth quarters of the pre-election years are notoriously strong. When we do that, like, midterm low, the pre-election year high study, which is in the Almanac this year, and you've seen it before.
Yep.
A lot of those, pre-election year highs happen in December, and quite a good number of them on the last trading day of the year. And and then I'll just look a little further out to election year. Sitting presidents running for re-election, whatever you think of the guy or the party in there, just the fact that there's an incumbent party and an incumbent person running again is very bullish for the stock market, because they're able to drive things from the bully pulpit and from controlling government to prime the pump for the economy and the market. And they've already done that. I think the deal that Biden made with McCarthy for the debt ceiling sort of pushed that off into the future, kept the spigots open on all the spending, and okay, so we're going to get a bit of a correction after next year. There's a different scenario, but let's not get too far ahead of ourselves.
Sure. Obviously in your newsletter, you talk about different things. You've got, the technical, seasonals, so on. I think you characterize in late July, the fundamentals as, quote, not bad, and the technical outlook is kind of mixed. And again, that was late July. Does that still hold now? And if so, why or why not? Why no more changes there?
I think it's continuing that way. We've got a little more seasonal weakness in the 5 disciplines that you cited there. I think the sentiment has backed off a little bit, but technically we're still bouncing around. We're still, sort of rolling, rotating through different sectors. Not a whole lot's changed. Yeah, we've come down a bit. Had a couple of weeks that weren't great. We're down, but not horrible. So we're kind of right there. We're in the worst 2 months of the year right now, and it's continuing to pan out. I'm sorry it's boring, but hopefully you got some cash on the sidelines or sitting, and we got those nice yields from bonds to wait, for the fatter pitch of the fall. And it's the last 3 years have really been tracking the cycles and the seasonals. Not every cycle they do this, so it's time to heed them and track them and trade on it.
Jeff, I'd never call our conversations boring. Don't worry about that. Monetary policy, I guess that's the one thing that everybody pontificates about a little bit here, and that's one of the disciplines as well. How do you see that shaking out over the next 6 to 12 months? I mean, everybody wants it's a parlor game. Are they going to hike again? Are they not? I'm just kind of curious what your work is showing in terms of what outlook that's going to have for the markets.
I mean, they've got to be close to the end. I've been saying that for a while. I mean, it's only been another couple of point hikes since we thought they might be over. I don't see why they need to do another one, but if that inflation number ticks up like we said it could, then I would expect them to increase again. They're trying to save face. They were late to start, and they went really hard out of the blocks. I give them credit for trying to get it together, but there's still a lot of inflationary pressures out there. I mean, I'm driving around this summer. We got the surfboards and the golf clubs and the family with us. So we got putting a lot of gas in the car, and it's not, it's not so cheap. Down south, it's what, 360, 370 in most places. If you get lucky, maybe 330, but that's rich. Food prices and everything else. And this, this disinflation, it's just not getting more expensive. It's not going to be coming down, and things are still catching up. So, it's going to be a while that the Fed may be, not sure, not really telegraphing what they're going to do. So maybe a quarter point.
Anything you'd want to add out there right now about sort of foreign versus domestic markets? I mean, I know a lot of your work is focused on the Dow, the NASDAQ, and S&P, and so on. I'm just kind of curious, what you're seeing in there. We had some speakers at our most recent event that were talking about how cheap emerging markets and foreign stocks are, and I don't know if there was anything your work would add to that.
I don't have a whole lot that I love overseas. Not that there's not opportunities there. It's not my bailiwick, but we're seeing some of the sectors that we like coming into play in the fall. Biotech's just starting, and then which is a great sector for the future, and it's taken on the chin a little bit. So, but this is cash time for us. This is sit tight, money market, bonds. I like the SGOV, the SHV is kind of where we're parking money right now. You're getting about 5%. Make sure you check the SEC yield at the iShares.com website, not the 1 year trailing, which is off.
Yep.
But that's where we're sitting. We're going to take a big swing when we get our MACD buy signal, you know, and we're going to be picking baskets of stocks. I mean, last year, Super Microcomputer was one of the stocks that came through our screen, and it was about 83 or something, 82 and change. We picked it. I mean, it doubled. We sold half on a double, and then it became the biggest holding of the Russell 2000. So, I mean, you can go foreign and all that stuff. We're going to do what we do, which is do a nice, robust, fundamental screen at the right time of the year, technically, you know, timed and proper buy limits. And we're going to pick stocks that are under Wall Street's radar when we get into October, November.
Okay. You know, that's kind of where I'm going to head to now. You mentioned October, November. I mean, you're going to be speaking at the Money Show in Orlando in late October. You know, I know it's always kind of hard to narrow this down this far in advance, but any idea about a couple of things you might want to be talking about, or you think it might be sharing with people there?
I'm going to be talking about next year. We're going to be doing a preview of 2024 and the best 6 months. I mean, I love that you guys have this on Halloween or around Halloween. It's just perfect. It's like teed up for me, pun intended, since I played today. But it's going to be getting ready for that Q4 of pre-election year and looking into the sitting president election year. And, you know, we'll talk about the super boom a little bit, which is pretty much on target. You know, that forecast I made in 2010 for 38,820 on the Dow.
Got it.
That'll be it. And we'll be talking about the new stocks that I'm putting out there, that we, you know, the screens and all the sectors that are coming into play. So there'll be lots.
Perfect.
Lots to talk about, lots to share.
Awesome. Looking forward to it. Anybody watching, if you want to hear more from Jeff and dozens of other top market and economic experts, do check out the Money Show Traders Expo Orlando. We're scheduled for Orlando 29th to 31st at the Omni Orlando Resort at Champions Gate. It is one of the nicest golf resorts in all of Florida. So for those who like golf, I believe one of whom I'm talking to now, great chance to go see that. And you can click the link in the video description to find more. And if you enjoyed this video or learned something new, definitely hit that like button or subscribe to more regular content from Money Show. Jeff, thanks again for your time. I'll see you in a little bit.
My pleasure, Mike. Be good.